Hey everyone, welcome to this explainer. Today, we're unpacking Dover Corporation's Q2 2026 earnings report. You know, if you've ever felt completely lost in a maze of dense corporate spreadsheets, well, you are definitely in the right place. We're going to cut right through the noise today to find the real narrative behind Dover's recent success. We're talking the exact numbers, the strategic decisions, and the segment performance that totally defined their quarter.
Let's just dive right into this with a pretty powerful hook from Dover's president and CEO, Richard J. Tobin. He establishes right up front that Dover isn't just, treading water in a complex global economy. They are actively securing double-digit bottom-line growth. And honestly, when the person steering the ship opens with a statement like that, it signals a massive level of confidence in the company's operational execution. It essentially tells us that despite whatever macroeconomic headwinds might be out there, their internal engine is just humming along. So here's our roadmap for today's explainer. First, we'll look at Q2 by the numbers. Then, we'll examine the engine of growth, move right into a segment-by-segment breakdown, analyze cash flow and margins, and finally, take a look at the road ahead.
All right, Section 1, Q2 by the numbers.
So the headline revenue figure here is just massive. Dover generated a staggering $2.2 billion in just the second quarter of 2026 alone. To put that into perspective, this reflects a highly diversified global manufacturing footprint that is basically running at near peak efficiency. But, an isolated number doesn't actually tell us much about the true momentum. For that, we really need to compare it to where they were just a year ago.
And wow, the growth trajectory is striking. GAAP revenue jumped 7%, going from $2.05 billion in Q2 2025 up to $2.19 billion this quarter. But the real standout? That's the bottom line. We're looking at a highly impressive 12% jump in adjusted diluted earnings per share, hitting $2.74 compared to $2.44 in the same period last year. Keep in mind, this adjusted EPS figure strips out all that accounting noise, like purchase accounting expenses and restructuring costs, which gives us a much clearer view of their true operational profitability.
Moving on to Section 2, the engine of growth.
Now, what is truly compelling here is the CEO's commentary on exactly where this revenue is coming from. He specifically points out that secular growth-exposed markets now make up about 25% of their total portfolio. And these are markets driven by long-term foundational economic shifts, not just those short-term cyclical trends. But the absolute best part? Bookings, meaning the actual orders coming in the door, are outpacing shipments and growing at double digits. So demand isn't just strong today, they're actively building a super robust backlog for the future.
So how is management actually using their strong balance sheet to keep this engine running? Well, they definitely aren't sitting on their hands. They are actively advancing capacity expansion projects to support all this growing demand. They're also funding productivity initiatives, which really helps explain how they're offsetting input cost inflation and driving those higher margins. And crucially, they are eyeing an improved industrial M&A pipeline, constantly looking for acquisitions and attractive end markets to just bolt right onto their existing portfolio.
Okay, Section 3, segment-by-segment breakdown.
Looking at their 5 distinct operating segments, the thing that jumps out immediately is just how balanced the revenue contribution is. It's led by heavyweights like Clean Energy and Fueling at $595 million and Pumps and Process Solutions at $553 million. But here is the vital takeaway for us. All 5 of these segments delivered positive organic growth in the quarter. That completely underscores the incredible breadth and durability of demand across totally different industrial sectors.
Let's look at the margin profile to really build out our picture of profitability. The undisputed profitability powerhouse here is Pumps and Process Solutions. Just look at that top line. An incredible 34.5% adjusted segment EBITDA margin for the first half of the year. Imaging and Identification also really shines at 29%. What this shows us is that while all the segments are growing revenue, certain divisions are incredibly efficient at turning those top-line dollars into real bottom-line earnings.
Which brings us to Section 4, cash flow and margins.
Now, before we get to the numbers, when we look at free cash flow, which is basically operating cash minus capital expenditures, we're really looking at Dover's strategic firepower. This is the capital that dictates their ability to pay dividends, reduce debt, or, chase after those big acquisitions.
So why does this matter so much? Because Dover generated an impressive $188.4 million in free cash flow in Q2 alone. That is up significantly from the $131.2 million they generated in Q1. In fact, their cash flow from operating activities as a percentage of adjusted earnings was nearly 64% in Q2.
This kind of strong cash generation gives management immense optionality to pursue those M&A targets we mentioned earlier, or as they noted in the report, to just keep returning capital to shareholders through their consistent 52-cent per share quarterly dividend.
Finally, Section 5, the road ahead.
Armed with excellent visibility from that exceptional order book, you remember where bookings outpaced shipments, management didn't just reaffirm their outlook, they confidently raised it. They increased their full-year adjusted EPS guidance to a new range of $10.55 to $10.75, based on full-year revenue growth expectations of 6 to 8%. Let me tell you, raising guidance halfway through the year, that is one of the absolute strongest signals a management team can send to the market about their internal confidence.
And that leaves us with a really compelling final thought for this explainer. We've seen the raw scale of their $2.2 billion quarter. We've seen the efficiency of their 34.5% segment margins and their strategic push into secular growth markets. Given this dynamic positioning and a balance sheet absolutely ready to deploy capital into an expanding M&A pipeline, the question isn't just about finishing 2026 strong, it's this. Is Dover perfectly poised to maintain this aggressive double-digit growth trajectory well into 2027 and beyond? Thanks so much for joining me for this explainer, guys. I hope these breakdowns really helped demystify the numbers and brought the core narrative of Dover's performance into sharp focus for you.